Welcome back to Investing Talk Podcast.
Today, we're looking at IREN.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The core story here is pretty clear, isn't it? This is just not the same company it was a year ago.
Not at all.
The whole story of IREN now is this rapid, really strategic transformation. They're moving so aggressively from being, a pure play Bitcoin miner.
Which is a very cyclical business.
Exactly. And they're moving into this full-scale AI infrastructure provider. Some people are calling it a neocloud model.
Right, and that's an important distinction. For anyone tracking this space, a neocloud is basically a new kind of data center built just for these massive GPU deployments. They kind of compete with, but also supply, the big cloud giants.
That's it. And the market is definitely starting to value IREN based on that new identity, not the old one. This whole pivot is what's driving everything.
And the market believes it's real because of one huge data point, right? The big one.
The massive validating contract.
The $9.7 billion AI cloud contract with Microsoft. I mean, a number like that, it just changes a company overnight.
It's the ultimate institutional seal of approval. When a company like Microsoft commits nearly $10 billion to your infrastructure, it tells you everything.
It says you've met the standards, the security, the reliability, all of it.
Exactly. It just removes all the ambiguity, and it shifts the entire risk profile of the business away from, the crazy economics of Bitcoin and towards stable, long-term contracted revenue.
And we are already seeing that shift in the financials. The numbers are, they're pretty compelling.
They are.
I was looking at the record Q1 fiscal 26 revenue. It hit $240.3 million. That's a 355% surge year over year.
Wow. And the full fiscal year 25 was what, $501 million?
Yeah, 168% increase. Big numbers.
But you have to look past the top line growth. It's the quality of the earnings. That's where you really see the transformation shine. The operating leverage is extremely high. We're seeing gross margins running near 70% and net margins near 76.0%.
Oh, on a 70% gross margin, infrastructure, that's almost unheard of. That sounds like a software company, not a company building data centers and buying GPUs. Is that actually sustainable?
That's the million-dollar question the market is wrestling with. But the bullish case is that, yes, it is sustainable because of their structural advantages, which we can get into.
Right.
Once the heavy lifting is done, the capital is spent, selling that GPU capacity is just incredibly profitable. And these contracts have built-in price escalators.
So predictable revenue.
Very predictable. It's what separates quality earnings from, volatile commodity earnings.
So the narrative shift is complete then. The market sees IREN less like a miner and more like a high-growth utility for the AI boom.
Precisely. And that's why analysts are scrambling to re-rate the stock. The sentiment is just overwhelmingly positive. The average 12-month price target is somewhere in that $52 to $73 range.
Which is significant upside from where it's trading now, around $40.
It's a lot of upside. And that's all because the market is willing to pay a premium for this safer, more predictable revenue.
Okay, so that future price is all based on this AI story continuing. So let's get into the weeds on that. What is their structural advantage? What protects those incredible margins?
The competitive moat is all about scarcity, specifically power and interconnection scarcity.
Right.
In the race to build out AI today, the biggest bottleneck isn't even the GPUs anymore. It's finding the power to run them.
I get that the demand for power is huge, but just how big is their advantage here?
It's massive.
Yeah.
IREN controls about 3 gigawatts of secured power capacity.
And to put 3 gigawatts in perspective.
That's enough to power a small city. For a competitor trying to start today, securing even 1 gigawatt can take years because of all the regulatory hurdles. IREN got ahead of the curve.
So they have the power secured while everyone else is stuck in line waiting for approval.
Pretty much. But it's not just the amount of power, it's the cost and the source. They use a lot of low-cost renewables, like hydroelectric.
And that's a double advantage, right? It's a lower operating cost for them, and it's a huge ESG selling point for a client like Microsoft who needs to meet those green energy goals.
A perfect alignment. Then there's the technical moat from the Microsoft deal itself. You don't just land a contract that big.
No.
You have to pass all these incredibly tough standards. And once you're that deeply integrated with a giant like Microsoft, the switching costs are just immense.
Which all ties into how they design their sites. They aren't purely dedicated to AI infrastructure. Places like Childress and Sweetwater are dynamic, right?
Exactly. That's the really clever part. They have this dynamic optionality. They can allocate their compute between Bitcoin mining and AI workloads, on the fly.
So if Bitcoin prices spike, they can mine more. If AI demand is higher, they can switch capacity to GPUs.
That's it. It completely de-risks their huge investment in power infrastructure. They're not betting on crypto or AI. They're betting on the long-term demand for high-density compute, period.
It's a very savvy move. Okay, let's switch gears to the less rosy side of things.
Yeah.
The stock's performance, the volatility.
Yeah.
Despite all this great fundamental news, the stock has been all over the place. It's been trading around $35 to $40, which is a huge pullback from its all-time high of $76.87.
You absolutely need an iron stomach for this one. It is not for the faint of heart. And that brings us to its beta.
Which is very high.
Very high.
Yeah.
Around 4.2. So for anyone listening, that just means when the market moves 1%, IREN tends to move 4.2%, for better or for worse.
And we've definitely seen the for worse side with these huge 8% or 9% dips on a bad day for the tech sector. It's gut-wrenching.
It is. But that's the price you pay for this kind of growth potential. You know, technicians look at this recent price action and they call it a classic pullback in a secular uptrend.
So the long-term trend is still intact, even with a 50% drop from the highs. What's the signal for that?
It's the 200-day exponential moving average, the EMA. It's still far, far below where the stock is currently trading. That 200-day is like the market's long-term heartbeat. The fact that the stock is consolidating well above it tells you the underlying AI story hasn't broken. The stock is just digesting its huge run-up.
With that kind of volatility, it's really important to see who's buying and who's selling. I know the CEO sold about 1 million shares, which never looks great.
Right, and that gets headlines, but it's often just planned selling for diversification.
Yeah.
I think the more compelling signal is the institutional accumulation, the smart money.
Like who?
Well, we saw Barrel Capital Management, for example, just bought 400,000 shares. That's a nearly $6 million bet. When you see funds like that buying into the volatility, it suggests they see it as an opportunity, not a red flag.
So the institutions are buying the dip. Okay, let's address the other side of that. Let's hit the bear case head on. If the story is this good, why the huge capital raises? What's the primary risk?
The primary risk, hands down, is overbuilding and capital intensity. You know, making this enormous, costly bet on future AI demand. We saw Jim Cramer even warn about it, telling people to take the gain.
He compared it to the dot-com bubble, right? The excessive build-out.
He did. And, you know, the critique has some teeth because they have raised a ton of money.
How much are we talking?
Over $3.6 billion recently through equity and convertible notes. And that creates two immediate problems for shareholders: dilution from the new shares and higher debt from the notes.
So the bear case is that IREN is spending too much, too fast, based on the hope that future contracts will show up. And if the AI gold rush slows down.
They're left with very expensive, empty data centers.
Right. But the bull counter-argument is that the capital is being deployed against signed contracts.
Against that Microsoft deal.
Exactly. They're spending money to satisfy known demand, not just speculative demand.
Ah, so that shifts the risk. It's not a question of if the demand is there. It's a question of how well they can execute.
That's it. Execution is everything. It's about how quickly they can turn that $3.6 billion into high-margin, revenue-generating infrastructure, which makes watching their operational updates critical. What are the key dates we should be circling on the calendar for the next few months?
Okay, so we have a few things. First, look for the Q4 preliminary operations update. That should be mid-December.
And that's where we'll see the details, right? The GPU installs, utilization rates.
Exactly, the granular stuff. Then the really big one is the Q3 fiscal year 26 earnings release in early February.
And for that, everyone will be looking at the revenue mix.
Ruthlessly. We need to see that AI and cloud revenue climbing fast as a percentage of the total. If it is, the story just gets stronger.
And beyond the scheduled updates, I guess the real wildcard catalyst is another big contract.
That's the speculative home run. The market is buzzing about the potential for another multi-billion-dollar deal, especially given how few companies have this much power capacity ready to go.
It makes sense. They're validated, they have the power. The demand is insatiable. If they land another hyperscaler, the stock would just explode.
It would. That scarcity is their most powerful negotiating tool right now.
So wrapping this all up, what does this mean for someone holding the stock? How should they be thinking about it?
I think you have to view IREN as a multi-year hold, probably 3 to 5 years. You need that much time for them to deploy all that capital and for the full earnings power to show up.
But because of that crazy high beta?
It's also a fantastic vehicle for position trading around those big contract announcements.
So it seems like iron is in this high optionality zone. They're basically trading all this short-term volatility and dilution for a shot at a dominant long-term position in the AI utility space. The key is execution. It all comes down to how quickly they can turn that capital into contracted revenue.
That's the whole story. And if you found this analysis helpful and want to track how they execute on that challenge with us, be sure to hit that subscribe button to catch all our future analysis on the market's most compelling companies.